After a somewhat controversial run-up to the 4th of July event in Washington, D.C., where, most of Washington, D.C. being Democrat, like 90%, there was a lot of griping about tanks ripping up streets and whatnot. Well, after all of that anticipation and also griping by liberals that the president was going to come on stage and talk about locking her up or something like that, there was actually a huge turnout to the event. If you look at this photo of the event, unlike the inauguration where, the president was, widely mocked for saying there was a huge turnout when there wasn't, this event did have a huge turnout, mostly by Trump supporters, as was reported. You can see the picture here of how many people were actually there. There was reporting of the fact that the tanks were limited to a few stationary tanks, and that was obviously the military had to kind of rein the president in there, and it must have been some tense moments as people told him that he was not going to have the huge parade of tanks, but rather some stationary tanks. But, the president stuck to a message of a patriotic message and did not pursue some sort of campaign event, which is what was worried about by a lot of people. Now, when I watch some of this footage, to me, it just makes me think, wow, what a pain this must be for elected officials to have to go through this long day of activities. Here you can see the baby, which they were given a permit for this Trump baby, although they weren't allowed to fly it actually in the air because the airspace permit was not granted. But at least as far as I understand it, but they did have a permit to have the Trump baby out there somewhere. But I just imagine what a hassle it must be for elected officials to have to go through this huge hours and hours long day of events. And I found this footage online. You can see the president and vice president here when the event finally takes place. It was raining out during the day. And if we keep fast forwarding here, we can see this is in the front. So if we go back to our picture here, all this stuff was happening in the front here of this picture, whereas the general public was mostly behind the Lincoln Memorial there. A lot of controversy was because some of the Republican party members were given free tickets to be right next to the president here, whereas the general public was behind in the back. And that created a little bit of controversy as we see the president come out here with his wife. Let me see if I can move kind of out of the way because I'm kind of right in the middle here. And as I said before, the speech was mostly kept to patriotic things and a little history lesson for people. You can see it was raining pretty strong right there, and there's this kind of glass screen in front of everyone. I don't know if that might be so that nobody can try to shoot the president or something. But there you have it. So the event was, as I said, very well attended, a lot by the supporters of the president who came out in force to support him in this event. All right, so as we come into Sunday of the weekend here, if you start to go looking through your charts, you're going to see that, for one thing, we are still in a big amount of contango. So even though we got a little pop coming into the weekend in volatility that kind of backed off, we're at 9% contango right now. So that really does favor people being short this stuff. And anybody who has been consistently short this stuff for the last couple months has made good money. Will this continue? Nobody knows. I'm not going to be the kind of person that comes on and tells you I know what's going to happen in the future. I certainly don't. But people who have stayed short this over time have done really well. I think that's a big misconception that is perpetuated by people who want to sell you stuff about trading, that there is always a known right or wrong thing to do in these situations, and that they always know what that is because they've have some sort of class or because they've analyzed a chart in a certain way or another. Whereas most of the time in trading, the actual right thing to do is very ambiguous and can be very tough to figure out, which is the case even right now as we look at stuff. I just wanted to make a little bit of a comment on how to be successful. And one of the things that's really most important is to just really protect yourself from losing money. If you can go into situations that you think are the least likely of losing money or have the least amount of downside, then what's left over is profitability. If you come into a situation saying, oh, well, I've got 10,000 here, I can easily lose 3,000, I'll still be fine, then you're going to watch that 3,000 disappear pretty quickly, it seems. It's kind of like a self-fulfilled prophecy. So you want to really try to protect what you have at all costs, because what's the point of trading if you're just going to lose money? You might as well just put money under your bed or something. I mean, I understand doing that, you lose the inflation percent, but inflation percent is nothing compared with how much money you can lose by being careless trading. And until you can get a handle on being profitable, I would recommend not risking a whole lot, because it's just going to backfire on you. So having a real concern about losing money is what should propel you towards being successful in the end. Now, having a concern and being emotional are two different things. If you set up a plan of how you are going to behave based on a stock or an underlying moving in certain ways, if you abandon your plan as soon as you lose a little bit of money and sort of panic every time that happens, you're going to find yourself not being successful as well. So I would say practice, diligence, hard work, it's just like for any other job really, are the keys to success for trading. And I'm feeling like everything is a little bit too white here. I have a white shirt on, I'm pretty pale, there's a white background. How can we fix this? Now let's take a look at some charts just for a second here. So I was looking back at some of the stocks I traded over this year so far. Here's Wayfair W, and this was one, if you remember back a couple months ago, the volatility was really exploded right before earnings, and we got this big move. And that's not going to be good enough here. We got this big, here is right before earnings right here. We were trading around 117, and I'm directly in the way. We were trading around 117 here, and I was trying to figure out what to do, whether to short it or go long it or what to do. And I was thinking about shorting, but I just laid off, and we got this gap up here, right? A gap up. And then once it got up here to like 150 actually, is when I decided to sell some out of the money calls and get a little bit short. And I was unable to hold on long enough. Eventually it did kind of, didn't really go low. It went lower by a little bit, but a lot of times when something is overblown and it seems obvious that it's overblown, you will be right, but you don't know at what point you'll be right. It could be like 3 years later. But this is a company with solid fundamentals. They sell expensive furniture. They are well known. They sell a lot of stuff. However, earnings negative. A company can't exist forever with earnings negative, but a company can, Amazon being the perfect example, a company that's rapidly expanding and selling a lot of stuff and growing rapidly can exist for a long period with negative earnings, and a stock can still rally a ton in a company like that. So there you go. I wanted to show you, I was looking for tickets for a concert, and I found Facebook I went to Facebook to see if I could get discounted tickets, and it is just full of scammers. And I just want to show you for a second examples here of scammers, because they don't look that real. I mean, they're pretty easy to spot. However, let me just give you an example of some of the scammers I've been dealing with trying to get these tickets to this concert. And we'll just go to it right here. All right, so I go online for tickets and I see all of these offers. So let's see. Okay, so details. See all posts, and there's a post by me asking for tickets. I've got tickets if at an affordable price. DM me if interested. Anyone looking for tickets? I've got tickets. All right, so let's just go down here and look at any. They all of them sound very similar, but let's just, sad I can't make it anymore. Okay, check this out. Amanda Jeffrey. Okay, you look, and it's a picture of a good-looking woman, married. However, when you look down, it says, instead of saying send her a message, it says, if you know Amanda, send him a message. Let's see if I can isolate that so you can see it a little bit better here. That is my first clue that something might be wrong with this profile, okay? It says send him a message there. All right, so then if you go down through this profile, and this is a lot of these ones here, you don't see any friends listed. You see like 1 or 2 posts in the last week, and that's it, right? And then I looked at like the likes on these posts. So I go here. Let me move slightly out of the way here. I looked at the likes on these posts. And I pull up the names from the likes. So I go here, click on the likes, pull up the names. Okay. They're all people in Nigeria. So you pull up a name, okay. This woman, she looks clearly like she's like white American or maybe Hispanic American, but every person liking her profile is from Nigeria. Now, how does that not a red flag for you? Okay, there's one person liking the profile. There's nobody liking this profile that's not from Nigeria. So that seems a bit sketchy for me to be sending money to somebody who apparently all their friends are Nigerian and living in Nigeria. Seems kind of strange for somebody who is supposedly living in the United States and has tickets to fish. I didn't know there was such a huge fish following in Nigeria. Here's another person, okay? Okay, this is the friends list of the other person disliking their stuff. They're all people from Nigeria. Okay, so here's Claire Smith, right? Here's another person. Claire Smith, checking to see if you still need my tickets, let me know. And when I asked these people where the tickets were, 2 people told me they were in the exact same row. Okay, so this person, look at her profile. Okay, it's a pretty girl with a dog, right? Pretty girl with a dog. You go down and you check out her friends, people that are liking it. Okay, let's just pull up one person of the 3 people that seems to be liking this photo. Okay. All of their friends are black people from Nigeria. All the pictures of their friends are like black people in Africa. This is another this is a separate profile from the one we were just looking at, okay? Let's look at another one of the people that like their photo. Okay, this guy is in Oyo, Nigeria. Okay. So these are just scammers, and they can't even hide because they've got friends who are also scammers, I guess, liking their portfolios. They can't hide it. But here she's Claire Smith, some pretty girl who wants to sell me fish tickets. Okay, let's try another one here. Let's just try another random one here just to see if we can. Okay, so here's a new one. Just got it 47 minutes ago. Elaine Tommy. Single photos. July 4th updated. July 4th updated again. Okay, let's see somebody that liked their photo. Okay, so this guy, like, it says beautiful face. Okay. He's from Nigeria. So everybody selling fish tickets is from Nigeria. It's amazing. I guess Nigeria, there's a huge fish following. Let's look at another person that liked the photo here. Okay. They're all Nigerian. So I'm going to put a message up here. Seems fish must be very popular in Nigeria. Everyone offering tickets is a Nigerian scammer. Just pick any picture on their Facebook profile and look at the profiles of the people who like their pics. They are all Nigerian. Yeah, isn't that hilarious? So I guess I'm not getting tickets there. Unfortunately, I picked the most expensive show to invite my friends to, and it's gonna end up being like $600 or $700 to get tickets for everybody. Oh well, what can you do? Too late now. But I'm not giving my money to Nigerian scammers. No, thank you. If you think, well, I just looked at one small concert that people are selling tickets to, there's got to be thousands of concerts with thousands of tickets being sold. I mean, these scammers have got to be pervasive online, and Facebook is being used for so much incredible amount of illegal activity. Now, do I think that means you should short the stock? No. But it does mean just be careful when you're out there. What you see is not always reality. It's the same thing with options trading or anything else. If something seems too good to be true, it probably is. Nobody just wants to give you money. The other thing, when I was looking for tickets, I knew that Ticketmaster were like $120. So I say to people, I'll pay $100 for 6 of them, and they say done. If somebody's not trying to negotiate with you to get a higher price, then they're probably a scammer also. They're just like, oh yeah, whatever. Other people said, I have 3 tickets for sale. Then I say, I need 4. And they say, oh yeah, I have 4 actually. It's like Scam Fest, America. So there you have it. Coming into the week with the market at the highs again. And, look at this chart behind me. This could go higher from here. We could just make new highs. All the fear and the worry could be for nothing, and we can just go way higher here. But people are on the sidelines because they're afraid, and they may be missing out. I did look at one stock this week, which I bought a little bit of, and it's already gone against me a little bit. But this is MNK, Mallinckrodt. Now, this is the company that actually makes the drugs that I was addicted to at one point. This company is the one that makes Perk 30s. They make opiates, and they've been sued almost out of existence. However, I'm just thinking that this stock is so low and ground into the ground by so much now, even though the company is profitable, that it seems like it might be a bargain. Look at this chart. It got down to 8 and change, and it's just sitting here on this basement level. And I really feel like this, if they can settle some of this lawsuit stuff and get their act together a little bit, that they can rebound from here. So I did buy a little bit of this. I paid $9. It's 35 cents off lower than where I bought it right now, but you know, just a little bit, and we'll see what happens from here. Also, ACB, I think ACB is an example where options really are a great idea to trade this if you want to be long this. Because look, you can buy the stock, okay? You can buy options. Now, if you buy a call option, it's like leasing the ability to buy the stock for a certain price for a certain period of time. So if I buy the December 9 calls, that's going to allow me to pay $9 for this stock for the next 166 days. Okay, paying $9 for that stock, this stock is not worth a whole lot right now because I could just go out in the regular market and pay $7.64 for the stock. However, if this rallies, if this gets taken over, or it rallies or whatnot, paying $9 for the stock might be a huge bargain by December. We just don't know. But we could look at something like the 7 calls, okay? So the 7 calls, you could pay for, let's even go out to January. The 7 calls, you could pay probably $1.10, $1.12 for them. So that means your break-even point would be $8.12. Right now we're around $7.50, so that's about 60 cents above where it's trading now. And you know, for $100 or $112 an option, you can have control of 100 shares of this stock above 7. Now our break-even point is going to be the strike price plus what we pay. So $7 plus, if we pay $1.12, then our break-even point is $7 plus $1.12 equals $8.12. Now that's not that far from where it is right now. So let's say we were to spend, so each one's $100, right? So let's say we were to buy 50 of these options. This is just straight out buying calls. And, you know, with options, you have to worry about them decaying. But when you buy stuff that's far out in time, it decays a very small amount per day. So if we pull this into our analysis tab here, if we were to buy 50 of these calls, that would cost us $5,700. And that would mean that we were long the equivalent of 3,380 shares. So for $5,000, it's as if we're long 3,000 shares. Now, if we were to pay if we were to actually just buy the stock, we'd have to put up over $21,000 to get this many shares. But if we use options, we only pay $5,000, and we have the same ability to make money to the upside. To the downside, we are not going to lose as much, but we will lose that entire amount of money if this stock closes at 7 or below. If we hold these options all the way to December, we will lose that entire $5,000. However, the upside is, A, you can sell this out at any time. B, now you're controlling this much shares, and actually buying 50 calls is actually controlling 5,000 shares. It says the equivalent of 3,380 deltas because these options are being priced in the model as having like a 60% chance of working out. So that's why instead of saying 5,000, if they had a 100% chance of finishing in the money, then we would say the delta was 5,000. But since we have just a little bit over a 50% chance of them finishing in the money, the delta is a little bit over 50. So 50 calls times 60 delta is about 3,000 deltas. So here you go. Now, if we wanted to figure out what the delta of these options are, or the percent chance of them finishing in the money, we can pull up on our screen, on our layout, we can switch it to something that has a delta in it. Here we go. So now if we look at these 7 calls, this model is giving them a 68 delta. That means these have a 68% chance of finishing in the money. I'm standing in the way of it, so let me move. If you look above here, price slices, it says 68 right where my pointer is. That means these have a 68% chance of finishing in the money. And if you think about it just sort of rationally, if stock's around 7, then what's the chance of it finishing over 7? Well, it's about 50-50 that it's going to be under or over 7 if it's trading 7 right now. That kind of makes sense. And you will notice that delta means different things here. We've got delta here, which is the percent chance of the option trading in the money, finishing in the money. But then when we look down here at our Greeks under price slices, delta here, this is the overall delta for our whole position. This here is the delta for one option. This delta here is for our whole position, and this also is going to tell you how much money you will make if this stock moves up $1. So according to this, if the stock moves up $1, you're going to make $3,380. And if it moves it down $1, you're going to lose $3,380. So if we are to look at this graphically, you're going to see that as things go higher, we make more money. And this is going to also illustrate here, this bottom line, that where our break-even point is. As we said before, it's going to be the strike price plus what we pay for the call. So if we paid $1.12 for the call, then our break-even price is going to be somewhere around $8.12. Now it has a slightly higher here because maybe it's just centering it a little bit differently, but essentially our break-even is around $8.12. Anything under there, we're going to lose money. And this is showing what will happen by expiration, this bottom line here. So by expiration, we're going to lose money unless this is above $8. We know that. How can we offset this risk, though, in the meantime? Well, what we can do is we can sell stuff against those calls we bought. So we could go ahead. Now, we could sell stuff right now without the stock moving, or we could wait until we get a little move up and then sell stuff. But let's say we just want to sell some stuff right now to help offset our losses from decay and just from the downside risk here. Well, we could go out to like August and we could sell some of these August 8 calls, for example. What if we were to sell 50 or 25 of these August 8 calls? And let me actually, before I even do this, let's look at what our theta was before we did this. So if I unclick this, our theta, or how much this position was costing us a day, is $10. So like I said, it's relatively small what this is costing us a day because the option we bought is so far out in time. So if we were to, let's say, sell 30 calls against this position, we were to sell some of the August 8 calls, all of a sudden, instead of paying $10 a day, we're collecting 3. Now we've sacrificed about a little over a third of our upside, but we're no longer paying decay. And now when we look at our risk profile, well, all of a sudden, we're not losing money. In the end, if we just sold these calls and they went out, and this is assuming the stock stays here until January. It's also assuming that these calls end up going out worthless. Thus, the stock, when we sold these August calls, that the stock on August expiration is below $8. In that case, the amount of money that we've collected by selling these 30 calls is going to cover our decay, and we will actually break even if the stock stays here. We will break even all the way out to January expiration. So if you were to sell these calls against your position, then you're putting yourself in a situation where your decay is covered all the way through January. And once these August calls come off your sheets, you've got your decay covered through January. So there's a lot we can do against these calls. Buying them outright is the best play if you feel confident that this is going to go up. But as time goes by, you can start to do stuff. If it does have a pop for a couple days, you can start to sell different calls against these long that you have. And any way you look at it, for somebody who's bullish this stock and feels that it's going to make a move sometime in the next 6 months, it's so much of a better deal to buy these 7 calls than to buy the stock. And for those of you who are not real savvy to options and hear these horror stories about people being short options and them owing money to a clearing firm and this sort of thing, you don't have to worry about any of that stuff when you're just buying calls, because just buying calls, you're not risking anything. You're not selling anything to anybody. All you're risking is what you pay for the calls. Now, when you start selling stuff against it, like that example I gave of selling 30 calls, if you add the two things together, buying 50 and selling 30, if you're net positive units, okay, if you buy 50 and sell 30, you're net positive 20 units. As long as you're net positive units, then you're pretty well protected. You don't have any what we call naked exposure. And as a market maker, we are very concerned with the number of units we have available, and we will do a lot and pay a lot extra to get that unit number either closer to positive or into a positive area, because that is what ultimately protects you from a huge blow up, is not having a lot of negative units. This is why when people talk about selling UVXY calls, even if a call seems way out of the money and it's impossible that a stock could go there, you still don't want to sell a lot of them, especially for cheap, because you're opening up a door, a way for you to lose a lot of money. And we never want to open up a way for us to lose a lot of money unless we're being well paid for it. So, I really like this trade of buying a little bit of Jan. Now, there is a risk to buying far out calls, and it's not as apparent in a low price stock like this one, because the premium levels are not that high. But if a stock is taken over in a cash deal, then any of these premiums disappear. So, for example, let's pick a higher priced issue than ACB. Let's pick Apple, for example. Now, there's no way anybody, I don't think, has enough cash to buy Apple, but just as an example, okay, if we look at Apple options, if we were to go out to let's go out to January 2021, okay, these options are worth a lot of money, okay, and there's a lot of premium in them. So let's say that let's say that you owned these January 240 calls. You pay $12 for them. And I'm just going to highlight them so that you remember which I'm talking about. So let's say you want to get long Apple, but you don't want to pay $200 a share. So you say, I'm going to buy calls instead. So you buy some of these Jan 240 calls. Okay, and let's say that somebody comes in and they take Apple over for paying $250. Okay. You might think, well, and it's a cash deal. Okay, you might think, wow, I'm going to do great. I'm long these calls and Apple's up $50. So I'm going to do great because the price of these calls is going to go way up, right? No, not right. Because in a cash deal, calls go to parity. So if Apple was trading $250 on a deal, and truth be told, if it was a cash deal for $250, Apple would trade it at a discount. But let's just say there's a cash deal, it consummates, it's a done deal, $250 price tag, cash deal. These 240 calls are going to be worth their intrinsic value. So the 240 calls, stocks 250, these are worth $10. So if you had been long a bunch of these calls, thinking like, well, I'm going to buy calls instead of the stock, because it's a cheaper way to get long, you would actually lose money, because these calls in a cash takeover would be worth exactly $10. So you pay $12 for them, you lose $2 on these calls, or $200 each, even though the stock goes up $45 on a cash takeover. So you want to be a little bit careful trading far out calls. People many times refer to far out calls as leaps, because that's what they used to be called in the past, was leaps. Long-term options. I can't remember what the acronym stands for, but you want to be careful, especially in a stock that may be in a deal, or as we call it, in play, to trade long-term options to the long side in one of these stocks. And the reason is, in a cash deal, everything is going to go to parity. And you can tell that this is going to happen because they'll start selling these calls at any price. They'll start crushing the time spreads, the calendars. They will, the difference between owning a call in January 21 and owning a call in Sep 20 will not be that much, because if the deal is going to happen in like October of this year, then all those calls are going to be worth the same price. So when there's a cash deal, you'll see them start to crush the time spreads. And I can't remember what the stock was, but there was a stock last year where they had a cash deal and they started crushing the time spreads. That's what they'll do. So the options paper is going to tell you what's going to happen. You just have to have the knowledge to interpret what's going on. But this is a caution when trading calls to the long side. I'm trying to think of like extreme things that can happen that can mess you up if you buy calls. And one of them is just a cash takeover deal if you're trading far out stuff. But that doesn't need to be your concern. And it still sticks, the premise still sticks that you can only lose what you pay for an option. Now, if you were to buy calls and then hedge them with stock, then the actual fact of hedging them with stock introduces another variable that can add to risk. But as a starting point for trading options, buying a call is a great spot to start, because you know how much you can lose, which is what you pay for something. And moving from there, a great thing to do would be to, once you've bought a call in whatever stock you're thinking of, let's look at another example, Candy, KNDI. After buying a call in one of these issues, like I said, Candy is trading 472, 489. Let's say you buy a DS5 call. The next thing that you might want to do is try to do something against that to reduce your cost basis. So let's say I buy 10 of these calls. Well, if you get a pop in the stock, you might want to sell something else against it. So maybe I go to August, a closer month, and I get a pop in the stock, and I'm able to sell August 6 calls for 20 cents. Now remember, when you're selling a call, you're giving up some upside. But you can model this stuff in the model. So if we were to look at the model, okay, being long 10 calls, it's going to have a risk profile that looks like that. You make money as it goes up. This is the expiration here, which shows you you're losing money. You're losing the maximum amount of money below this 5 strike. And as it goes up, your break-even point here would be 5 plus what you pay for the calls. So in this case, 585. And it shows right on the graph here, your break-even point is 585. Now, if you were to introduce selling some sort of calls again, like we did in ACB, so let's look at, okay, well, maybe I'm going to sell some September 6 calls. I'm going to sell September 6 calls for, let's say, 20 cents. I'll sell 5. Okay, well, that reduces your delta by a little bit, and let's look at how it changes your risk profile. Well, all of a sudden, your break-even point went from 585 down to 525. So that's interesting, right? The principle that the closer months decay faster than the farther months is something that you can use to reduce your break-even point from 580 down to right where the stock is now by putting this sort of spread on right here. Now you might ask yourself, well, shouldn't I just, instead of buying 10 and selling 5, shouldn't I just only buy 5 of these calls, the these calls? Well, if we try just buying 5, it's going to have a different profile because you don't have the advantages of different times. If you just buy 5 of the calls, your break-even point is still 580. It's just that you're losing less money or making more money as you get farther away from that break-even point. But with turning it into a spread and buying 10 of these calls and selling 5 of the closer months, you lowered your break-even point effectively. So it's not the same thing as just buying 5 calls, buying 10, and then selling 5 front month against it. A great way to practice with options is to just pull up this Analyze tab and try stuff out. I would recommend that. There's all kinds of stuff out there. As the world of options opens up to you, you're going to see there are all these opportunities out there that you didn't know existed. And we're just talking about some basic spreads of buying one call and selling another. There are so many other things we can do with options moving forward, but this is just a basic thing to check out to start with. All right, so thanks for watching, and I will see you next time on the Short Vol Show Live. Enjoy the rest of your week.